The Bank of England held rates at 3.75% this week, yet markets are now pricing in up to 6 hikes before the year is out. That is not a contradiction, it is a threat calculation. The same day the BOE voted to hold, the 30-year gilt yield touched 5.7%, its highest since 1998. The 10-year crossed 5%. The mechanism is oil. The Strait of Hormuz has been effectively closed since the end of February. Around a fifth of the world's oil and gas moves through that waterway. With that route cut, every major supplier, Norway, the US, West Africa, faces a surge in demand against constrained supply. Brent crude hit $126 a barrel this week. That is not a Middle East story anymore. That is a UK inflation story. The BOE's own modeling is explicit. If oil sustains above $130, the Monetary Policy Committee has warned inflation could exceed 6% and rates could climb back to 5.25%, erasing all 6 cuts delivered over the past 2 years. Halifax data released Friday shows UK house prices fell again in April, with the average now £299,313. Rightmove confirms 2-year and 5-year fixed mortgage rates have already risen to 5.1% from 4.3% in December. Buyers can feel the future rate path in current mortgage quotes before the BOE has moved at all. The BOE's chief economist Hugh Pill is expected to lead calls for an immediate rate rise at the next meeting, with at least 2 MPC members already pushing for action. The countersignal sits in the same data. Monthly house price declines slowed to 0.1% in April from 0.5% in March, suggesting demand has not collapsed yet. That resilience is the condition the BOE will watch. If it holds, the hikes come slower. If it cracks, the MPC faces a stagflation trap, rising rates into a weakening economy. But the gilt market is not waiting for that answer. Bond vigilantes are already pricing the downside.
That same oil shock hitting UK mortgage holders is being booked as profit in Shell's trading room. Shell reported first-quarter profit of $6.92 billion, beating analyst expectations on what it called exceptional volatility in energy markets. BP doubled its profits to $3.2 billion in Q1, with its trading division delivering an exceptional performance. The BBC calculated that oil and gas majors, Shell, BP, Total Energies, ExxonMobil, Chevron, collectively profited from the same supply disruption that is now pushing UK energy bills and petrol prices to near record levels. The divergence inside the FTSE 100 is the market signal worth watching. IAG, British Airways' parent, warned this week that its full-year jet fuel bill has risen to €9 billion, up from a prior forecast of €7.1 billion, a €2 billion increase it expects to only partly offset through fare rises. IAG CEO said the impact of higher fuel costs will inevitably lead to lower profit this year. JD Sports warned of muted growth and lower profits. Next said it will hike prices by up to 8% outside Europe. Weatherspoons warned on profits again. As a countersignal, 70% of IAG's jet fuel is hedged at pre-war prices through year-end, providing a buffer that smaller carriers do not have. And Goldman Sachs specifically flagged the UK as especially exposed to jet fuel inventory depletion. UK inventories could fall to critically low levels if Hormuz remains closed. That is the threshold to monitor. If US jet fuel is rerouted to Europe, as officials are now exploring, the shortage risk eases. If Hormuz stays closed into summer, airline schedules face rationing pressure regardless of hedging. The divergence between energy producers and energy consumers inside the FTSE is not a short-term earnings story. It is a structural split that widens the longer the conflict continues.
The gilt market did not just react to oil this week. It reacted to a ballot box. Labour lost more than 250 council seats across England on Thursday night. Reform UK gained nearly 400 seats. That outcome triggered the sharpest single-session rise in 30-year gilt yield since the Truss mini-budget era, with 30-year borrowing costs briefly hitting their highest level since 1998. The mechanism is not electoral sentiment, it is fiscal credibility. Saxo strategist Neil Wilson said the bond vigilantes are lurking, and that any challenge to Starmer's leadership, particularly from a more left-leaning rival, carries with it a perceived risk to Rachel Reeves's fiscal rules. Those rules are the binding constraint keeping UK sovereign borrowing costs from pricing in a full credibility discount. A leadership transition, even a rumored one, raises the probability that those rules get softened. Markets are not waiting for a leadership vote to price that risk. They moved on the election night itself. Starmer survived the weekend, vowing not to walk away. Gilts recovered partially on Friday, with 10-year yields pulling back 8 basis points as traders assessed that the worst-case scenario, an immediate leadership challenge, had been averted. The pound recovered to 1.36. But the recovery was conditional, not structural. ING's Francesco Pesole noted that some reform gains were seen as a less problematic scenario for gilts. Reform is not associated with fiscal expansion. The fiscal risk premium is still embedded. It has just been partially compressed. The verification benchmark here is the 30-year gilt yield. It closed the week above 5.6%. If it falls back below 5.4% in the coming sessions, markets are pricing Starmer's survival as durable. If it climbs back above 5.7%, the vigilante pressure has returned, and either a new oil spike, a fresh leadership story, or both will be the trigger. The leaning is that the yield stays elevated. Inflation expectations are rising, the BOE rate path is shifting upward, and the political risk premium has not fully dissipated. The condition that would prove this wrong, a ceasefire announcement that brings oil back below $90 alongside a credible signal that Starmer's position is stable through the autumn. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.